Well, you got my bells ringing a little bit when you said tax efficient. So, but so explain. Can you expand on that?
Yeah, so from our perspective, we're trying to be as holistic in our tax strategy as possible. It means from the very outset and then throughout the entirety of the holding period. So, um, another one of the misconceptions about mobile home parks is that folks sometimes don't know. They might think that you can't depreciate a lot of that asset, right? So a lot of people investing in real estate, one of the benefits is you get a lot of depreciation that
Yeah.
offsets your passive
Mhm.
income along the way, right? And in the mobile home park sector, folks are often if they're unaware, they're shocked to realize that mobile home parks are remarkably tax efficient. They're typically about 2 to 3 times more tax efficient than multifamily and maybe some other real estate sectors. By way of example, somebody that invested in our most recent fund in 2023, that invested $100,000 by way of example, received a passive loss in their K1 of $135,000. So if you could take that phantom loss of 135,000 bucks and offset your other income, you could literally save on after tax cash on cash returns tens of thousands of dollars year one. And I haven't even begun to send outbound distributions from the cash flow that the assets throw off, right? So they're remarkably tax efficient at the very outset of the respective investment. And then the manner in which we've structured our business is again holistic to try to help you keep as much of your hard-earned money in your pocket along the way as we possibly can, right? We do a buy, improve, refinance, and hold business model. So buy a deal with a nice margin of safety, improve the asset. Once we've stabilized the deal, then we'll do a cash out refinance. A lot of guys typically sell the deal here. We've done that on numerous occasions. We've now, what we like to think, we've seen further than others because we've done it a bunch. We realize the better option is to ultimately just do cash out refinances, get all the chips off the table in a non taxable event. Because again, you don't pay tax on a cash out refinance because it's debt. And fortunately, the residents truly are the ones paying back that respective debt over time, not you, right? So we pull that capital off out of that respective property via cash out refinance, get the chips off the table. From that point forward, we like to say we're on an infinite cash on cash return because we've gotten all that investment back. And then we just continue to enjoy the cash flow that these assets throw off over very long periods of time. So again, that's a very, very, very tax efficient way
Mhm.
to manage capital and try to drive returns on behalf of investors, in my humble opinion.
Brian, in that example you had mentioned, they put in invested 100, had a loss of the K1 of 130. What is triggering that loss?
Yep. Great question. So you guys are likely familiar with the Tax Cuts and Jobs Act of 2017. When that
Mhm.
was enacted, it allows for really high quality accelerated bonus depreciation. So if I look at big buckets of different real estate sectors, typically commercial real estate is 39-year depreciation schedule. Residential real estate, multifamily included, is 27 and a half year depreciation schedule. But when you're buying a mobile home park, what are you buying? It's not really considered commercial. It's not really considered residential. What are you really buying? And the reason I say it's not really considered residential is because when we buy a mobile home park, we don't like to own the homes. We're really just buying the land. And if we want the residents to own their own homes and then just
Yeah.
pay us lot rent. So what are we buying? If we buy $1 million mobile home park, what are we buying? You can't depreciate the land. And a mobile home park, it's about 20% of the purchase price is typically the land. What's that 80% then? So what would the $800,000 in that example be? Well, in that example, the vast majority of that purchase price is associated with the roads, the curbs, the gutters, the underground infrastructure, the utility lines, and all of that infrastructure is considered capital improvements, which is on a 15-year depreciation schedule. And because of the Tax Cuts and Jobs Act of 2017, all of that can be accelerated via accelerated bonus depreciation into a much, 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 much shorter horizon. For many, many years, 100% of that could be depreciated in year one. That's slowly dwindling down over time. This year, it's ultimately, I believe, 60%, and it'll continue to dwindle depending upon who wins the election and ultimately if this gets extended beyond 2026, I believe. But that is largely why we're already on a much shorter schedule, right? 15 years is a heck of a lot shorter than both 27 and a half and 39. But with the Tax Cuts and Jobs Act, anything that was 20 years or shorter can be accelerated into year one. A portion of it, at least, can be accelerated into year one, which makes it just ridiculously profound in terms of their tax efficiency.
You want to see the entire episode? Click here. If you want to learn how investors use infinite banking to increase their returns and lower their taxes, click here. If you want to see if infinite banking is for you and you have some questions, hop on a discovery call with us and one of our coaches. The link for that will be in the description.